Welcome back to Marina Teaches for another tutorial. Today we'll be looking at the generally accepted accounting principles. This tutorial is perfect for those who are studying accounts or entrepreneurship for the first time. If you are thinking of starting or running a business, you should know that it's not only about making money. You also have to keep track of all the money which passes through the business. That's where accounting comes in. Accounting is the process of recording, summarizing, analyzing, and interpreting all the financial transactions related to the business. This helps stakeholders to make informed decisions and judgments, which would increase profitability and accounting information is based on key concepts, which are called the Generally Accepted Accounting Principles or GAAP. These rules are followed by accountants to ensure the financial information is relevant, reliable, and comparable. They are adhered to when preparing financial statements and when reporting transactions. Be sure to stick around until the end of this video for a fun activity on these principles. What are these generally accepted accounting principles, you might ask? We're just getting into that. In fact, the following acrostic should help you remember. Mr. Happy Gorilla organized everyone's masks, costumes, dates, and presents for the party. The first letter of each word represents one of the GAPs. M for Mr., M for Money Management. This GAP specifies that only items that have a monetary value can be recorded. It is quantitative rather than qualitative. After all, it's all about the cha-ching. H for happy, H for historical cost. The historical cost gap specifies that items must be recorded at the price which you paid for them. G for gorilla, G for going concern. The going concern gap is an important one. It assumes that the business will continue for an indefinite time period. This objectivity gap term states that the values used by the accountant must be factual and should be able to be verified by just about anyone. Next, we have the materiality concept. This gap specifies that when recording, we record items that are sizable or represent a large part of the business. The consistency concept states that the same procedure for treating similar items should be maintained by all times. For example, when recording depreciation, if a firm uses the reducing balance method for 1 year, it must use that for all subsequent years. The double entry principle is like the law of accounting. This basically means that every transaction affects at least two accounts. As the old saying goes, every credit entry must have a corresponding debit entry. Another important gap is called the accruals concept, also known as the matching concept, which basically means that when calculating profits or loss for a period, all the revenue and expenses must be taken into account whether the cash was actually paid or received. That means that all your revenues and your expenses must be recorded within the time period. This allows firms to cater for prepaid expenses and amounts owing to them and amounts they owe within a given time period. It also helps firms to be prudent and not to overstate or understate their profit. I'm sure we've all heard the famous saying, do not count the chickens before they hatch, not so? Right. This philosophy underlies the prudence GAAP concept, which says that profit should not be overstated nor recorded before it's earned. Your costs should also not be understated or stated for less than they actually are, as this may inflate your profits. If you anticipate a loss, you can record it if it is likely to occur. Lastly, we have the periodicity gap, which states that accounts must be prepared for a specific time period, usually 1 year. The financial year may not necessarily be a calendar year, January to December, as it would depend on when the firm has started its operations. Reports can also be prepared monthly, quarterly, and semi-annually. These are called interim reports. Now, let's review our gaps. Do you remember our short acrostic? Say it with me. Mr. Happy Gorilla organized everyone's masks, costumes, dates, and presents for the party. Hopefully these will help you remember the following generally accepted accounting principles, which include money measurement, historical costs, going concern, objectivity, business entity, accruals or matching, consistency, double entry, prudence, and periodicity. Before we go, can you help me figure out which gaps I should use in these scenarios? We only have 2. Let's do this. Don't forget to smash the like button, give this video a big thumbs up, share it, and comment down below any other topics that you would like me to cover. Bye! Thanks for watching!